If you take out too much money as an owner distribution from your S corporation, you will actually pay capital gains tax on those distributions. You might think, well, Boris, S corporation is a pass-through entity. There is no double taxation. You are wrong, my friend. There is if you take out way too much money as distribution. Now in this video, I will number one, show you how distributions from the S corporation work. Number two, I will show you what does too much money mean and how much can you or you should not really take out so that you do not pay extra capital gains tax on your S corporation distribution. And number three, I will show you that if you did took out too much money and now that you have to pay taxes, I will show you how not to pay taxes legally so that you are in compliance with the IRS and do not raise any red flags. Ready? Let's go. Hey, before we continue with the strategy, just very quickly, my name is Boris Musheyev. I'm a CPA and a tax strategist. Every Tuesday, I release a tax strategy video here on YouTube so that you, the business owner, can learn how to pay less in taxes. Please go ahead and subscribe to my channel if you like my content. Hit the bell icon so you are notified every Tuesday when I release a tax strategy video. I would like it if you like the video. If you do, leave comments so I can answer your questions. And of course, share with your friends and family. I've also put together a bunch of resources in the description section below. So go ahead and check it out. Now let's get started. All right, awesome. Now let's start with how do S corporation distributions work. In order for us to understand how is it that you're actually paying taxes on your distributions, we need to understand how this S corporation distributions work. And in this example, I'm going to use my client Sam. We actually just went through this last week with Sam. He has a dental practice, and we're going to use him as an example, perfect case study, how he had extra distributions from the S corporation for which he had to pay taxes on, and how we actually went around it so that he does not. Now, Sam has a dental practice, right? And we're going to use his example to learn how S corporation distributions work. Oh, excuse me. Water is always good. All right. So Sam made $3.1 million in gross revenue in his dental practice, okay? Then he had about $2.4 million in expenses, and he took out an owner salary of $512,000. So you have gross revenue minus expenses minus owner salary. He had $132,000. Again, $132,000 in profit. Now Sam can take out the entire $132,000 from his business as an owner distribution, and he's totally allowed to do that. Now, a lot of people ask me, well, Boris, do I pay taxes on my distribution? Generally, no. If you take out up to $132,000, whether it's $10,000, $20,000, or $30,000, you don't pay tax on the distribution, you pay tax on a business profit. Because S corporation, it's a pass-through entity. All the income and expenses gets passed through to its owner. Hey, Boris Musheyev here. Sorry for the quick interruption. 5 seconds, I promise. I want to make sure you get your free PDF, 7 write-offs every S corporation business owner must know. The link to this free PDF is in the description below. That's it. Thank you so much. Continue watching. So in this case, Sam had a $132,000 business profit, and all Sam had to do was take out $132,000 in distributions and be a happy camper, not pay any payroll taxes on it as well, because that is really the main difference, the main reason why a lot of business owners decide to become an S corporation. But his case was a little different. He's a new client of ours. Now his case was a little bit different. He had, let's just go and jump in over here. He had a profit of $132,000, like I said, but he took out $312,000 from his business, cash as owner distribution. That means he ended up taking out $180,000 above than he had in a profit. This triggered an excess distributions. Excess distributions means you take more money out from the business than you have equity in it, okay? And that triggered $180,000. And this is, by the way, is a common mistake with a lot of business owners. I bet you right now, most of you watching this video, you have excess distributions on your business taxes. You just do not know about it because your tax preparer does not talk to you about it. If you're not working with a tax advisor on all of your tax strategies and having quarterly meetings to discuss specifically this information right here, I can guarantee you, if you get audited, there will be an issue. I will explain to you how. If you open up your S-corporation tax return, pay attention on a balance sheet. There's probably an item there that's called loan to shareholder. What a lot of accountants do is that when they prepare taxes during the busy tax season, and there's an excess distribution, like, oh, this owner took more money out than he's supposed to, most tax preparers do not address this issue with you, the business owner, and they just stick the plug number into the loan to shareholder because it's just easier to do that. But IRS does not like that and does not endorse it. Now, what happens is that when you have an excess distributions, IRS says you took more money from your business than you're allowed to, and you have to pay capital gains tax on it. Now, Sam had $180,000. It would not be a pleasant phone call. Hey, Sam, by the way, you got extra $180,000. He's a new client. You have to pay taxes on it. Instead, as tax advisors, we have investigated it. There's two reasons why anybody, including you, would have excess distributions. Number one, you have an incorrect beginning basis. What does that mean, Boris? Don't use these terms on us. Follow me through on this. When you start your business, you probably started with some capital. That is your beginning basis in your S-corporation. Think about how much your equity you have in the business. Every time you make a profit in your business, your equity goes up. And then you take the money out as owner distribution, your equity goes down. Before 2021, right? Before 2021, IRS said, hey, it's your job as an accountant, as a business and a business owner, for both of you, to keep track of your basis. How much is your basis? You don't have to report it to us. But accountants got very careless with this. And yes, I am blaming accountants because this is accountants' job. They got very careless with it. And in 2021, IRS said, you know what, from now on, I want to know what is the owner's equity in the business. And they created a new form, Form 7203, where you have to report this. When we received Sam's 7203, guess what? The beginning equity, the beginning basis on top was zero. His accountant didn't even take time to figure out what his basis is, and he reported it as big zero. That means when we did the 2022 return, there's no basis, and he took out $312,000 in distributions. But the question comes in, where the hell is the rest $180,000 come from? Did he have an extra cash? There's definitely no profit. Must be the basis was not calculated correctly. So I called Sam and I said, Sam, can you give me tax returns going back to 2014 when you started the business? We reconstructed the basis and we found out that out of $180,000, he had $140,000 equity in the business. That means on $140,000, he does not have to pay excess distributions tax. That is a huge difference. Only your tax advisors, by the way, would do it for you. Tax preparers, they're just busy to get the taxes done. Now, out of 180, right, we found $140,000. That was the beginning. Now, he only has to pay taxes only under $40,000. Yes, he still has to pay taxes. And that brings me to reason number two. Now you might say, well, Boris, how did he take out $40,000 more from the business than there was cash or his equity? And the answer is, which a lot of you went through, but most of you don't know this, is because you have loans in the business in which against you took the money out. During pandemic, a lot of business owners received an SBA loan, $150,000, right? Everybody remembers that. But some of them actually received more than $150,000. And because they were struggling with cash, they dipped into the cash of the business. They took it out as distribution, right? Above their profits. Hey, Boris Musheyev here. Sorry for the quick interruption. 5 seconds, I promise. I want to make sure you get your free PDF, 7 write-offs every S-corporation business owner must know. The link to this free PDF is in the description below. That's it. Thank you so much. Continue watching. Where did the money come from? Where did the cash in the bank come from? It is from that SBA loan or any other loans, right? If you took out loans for the business, whatever that may be. I had a couple of clients that took out PayPal Capital or Stripe Capital, whatever that may be. and you took that money from the business, instead of using it for the business, IRS says, no, 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 no. You gotta pay tax on that, right? Because you took more money than you're supposed to. So Sam, out of $180,000, 140 was the beginning, which his accountants never bothered to calculate what is his equity in the business. We reconstructed that, right, to show the IRS that, hey, this is legit. He's got $140,000 equity in the business. He doesn't have to pay tax on that. The other $40,000, unfortunately, he does have to pay taxes on it, but there is a way not to. And that brings me to my next strategy right here. And this is where you can take out more money from the business than they're allowed, and you don't have to pay tax on it. But if you structure this distribution properly, what does that mean? Now, I told you earlier that a lot of accountants stick the excess distributions in the loan to shareholder, and IRS frowns upon that, because in order to give a loan to the owner of the business, IRS says, look, we have no problem with you doing that, but you've got to treat it as a real loan. Put together a loan agreement, okay, and make sure it has the minimum interest rates that is approved by the IRS. These are called AFR rates, by the way, and they're available online on the IRS website. When you put together a loan agreement that the business is loaning money to the shareholder, and the shareholder now has to pay that back to the business, then guess what? In Sam's case, he had extra $40,000 left. Well, we did a loan agreement. We recommended him to do a loan agreement so that he takes the money out as a loan instead and not as distributions, and then he's going to pay back that loan. Now, this strategy doesn't work for everyone, because sometimes business owners be like, Boris, I'm not going to repay back this loan. This is the money that I needed. Then, well, unfortunately, you would have to pay capital gains tax on it. In Sam's case, it did not make financial sense to do that. Why? Because he had a loan in the business and he took the money as a distribution against the loan. I told him, Sam, you have, between federal and state, federal capital gains tax rates and the state that he is in, that's 35% tax. That is like paying 35% interest rate on your business loan that you took out on a business. Not a smart move. Structure this as a loan, and then pay back the loan according to the agreements of the loan terms. He said, all right, awesome. And guess what? $40,000, right, that was left over out of the 180, now turned into the loan. And guess what? He did not pay any tax on it. He does have to repay back the loan. Now, that is structuring the loan agreement. For those of you that have an excess distributions of $10,000 or less, the IRS actually says you don't need to do an interest rate on that. You don't have to pay it back with an interest. Just take it out and then just pay that money back, which is pretty awesome. That's if $10,000 or less. Now with Sam, it was $40,000. So basically, what happened in a nutshell? Sam had $132,000 in profits, but he took out $312,000 in distributions from the business. That means he exhausted the $132,000, and then he had some cash and equity in the business, but he's accounted incorrectly. Well, not even incorrectly. This dude didn't even calculate the basis, right? So he had $180,000 extra that he had to pay taxes on. $140,000 came in from the fact that he had equity in the business, which was never calculated by his tax preparer, and that's where we came in and recalculated that for him. Then he was left with $40,000. Then he made a loan agreement and basically took that out as a loan from the business and out as a distribution, on which, of course, he did not pay any income taxes, because the money as a loan is not subject to income taxes or capital gains tax. Ladies and gentlemen, if you have a tax preparer, you do not have a tax planner and advisor to help you through these things. Tax preparers just churn the returns out and out and out and out. I see this common problem with a lot of business owners that come in to us for their advisory and then they stay with us for their tax preparation. We fix this for a lot of our clients because other accountants do not take time to properly do this to make sure that the client is in compliance and not pay any tax on it. I mean, think about it. In Sam's case, his accountant did not even bother calculating the beginning basis that he had in the business. That is a huge mess up. Okay, that is a huge mess up. Now, ladies and gentlemen, I hope this was helpful. Thanks so much. Until the next time.